Markets are still bearish, David, and that's despite what we've seen by way of bond yields rising somewhere in the region of 12 to 15%. We've just had this conversation with Samir. But despite that, it's just taking a while for this market to gain ground. How do you see the challenges?
Well, when you consider having low multiples, on average, stocks trading at 10 times or below earnings, below one price to book, you would expect to see a bit of interest in the markets. But don't forget, large participants in these markets are either foreign or institutional investors such as pension funds, where yields in the bond market or in the fixed income space generally is between 16 and 18%. It's a no-brainer. You're going to see a lot of interest in the fixed income space and asset switching in terms of institutional investors, i.e. pension funds and asset managers. With regards to institutional investors from abroad, they're still facing their own issues, and these things weigh in heavily on the market. We find that our market is about 60 to 70% correlated with these markets as well. So it's not surprising that the bears still dominate the market.
All right, when we head over to the equity side, we are seeing a slew of results coming through, many of them just showing steady growth on the part of the banks, the bigger banks, and also on the consumer goods side. EBITDA is looking a little bit better than we've seen them in recent years. But again, that's not driving investment on the equity side. We've just seen Fitch giving, for instance, Access Bank a rating of B- for its viability and giving them a positive ratings watch. If these are the kinds of more positive assessments that are coming from outside on the banking sector, will it help to lift sentiment going forward?
Well, we would hope so, particularly with the banking sector. The banking sector has been the worst performer for 2 years. You would think that with Access Bank releasing, a modest top-line growth of about 6%, PBT growth of about over 40%, and a PAT growth of over 60%, clearly. And then also, don't forget, they've also had a flat cost-to-income ratio, and they've had better efficiencies as well. With that said, you would expect, an affirmation from ratings agencies such as Fitch. But also, don't forget that these overhangs, as we've discussed earlier, still remain in the market. Nigeria presents a viable investment opportunity for investors locally and abroad as well. But still, the global sentiments rest heavily on what's happening in this local market.
Right. We've just heard news of at least some ground in terms of the implementation of the Sovereign Wealth Fund. What's that investment strategy going to be like? Because obviously they're going to have to start investing in the market with some of the windfall earnings from oil. What sort of asset classes are we going to see them entering into? How's it going to be packaged? In as much as it's called the Sovereign Wealth Fund, there are actually 3 funds in there. There's the Future Generations Fund, there's also the Stabilization Fund and the Infrastructure Fund. With the Future Generations Fund, largely it's an equity play. So you will find about 60% of the of that fund going into equities, about 20 to 25% going into private equity and real estate, and also you would have probably about 15 to 30% going into fixed income. Don't forget, it's not going to solely focus on the Nigerian market. So we probably expect between 10 and 20% of the total value of that fund going into the equities market. That should somewhat lift the market, but obviously we don't expect to see an asset bubble, as it were. With the Stabilization Fund, it's largely a fixed income play. Don't forget, in the documentation provided by the bill or the law, basically that fund could be called upon every 90 days, every quarter, by the Minister of Finance. So it's largely it's a short duration money market type fund. With the Infrastructure Fund, it's a 80%, 20% infrastructure play. And I think it's pretty good.
and the kinds of returns that investors will see across the various segments, and also the influence it will have on subnational bonds, because governors have been really worried about the sovereign wealth fund.
With regards to returns, we would think that the Future Generations Fund should yield between 20% and 25% return. Don't forget, it's a long-term fund as well, and it comes in at a fantastic time. Prices are at really low levels, and they can take advantage of those. With the stabilization fund, probably somewhere between 5% and 10%. Don't forget, it's a mixture of assets from foreign markets as well as local markets. US dollar assets are probably yielding between at the gilt edge end, roughly between 0.25 and 2% at the long end, and then you can then go to the peripheral economies as well, like Poland and oil-rich commodity producing countries as well, yielding between 5 and 7%. So in US dollar terms, with that, you probably find that fund to yield about 5%. With regards to the effect on subnational bonds, the funding for the sovereign wealth fund is coming from the excess crude account. Currently, the excess crude as a proportion of the funding to states currently is about 4%. So we don't expect a huge issue here.
Okay.
However, states with states that are not oil producing or have a large IGR, internally generated revenue, should suffer a bit more than their peers.